Okay, thank you. Now we're bringing in our guest today, which is Eric Parnell of Great Valley Advisors. Uh, Jeff, welcome to the show. Or Eric, I'm sorry, welcome to the show.
Mike and Jeff, it's a great pleasure to be with you here today on Money Matters TV.
Hey, can you give me just a quick background? I know we have some other questions I want to hit on here, but quick background on how you got into your business. How'd you become interested in finance and what type of clients is it that you're serving?
Absolutely. Well, my path has definitely been a little bit unconventional. I actually started in the industry as an economist. I was a microeconomist working down in Washington, D.C. in antitrust, and made my way back up to the Philadelphia area working as a macroeconomist in the late 1990s. From there, I got on working in investment communications, basically with, for an investment management team, providing investment communications to their advisors and their clients. And then in 2005, I started my own registered investment advisor. And at the same time, I became a full-time professor, first at Westchester University and then at Ursinus College. So that was the stretch of time from 2005 all the way up to 2022. And in 2022, I made the decision. I said, I don't want to be independent anymore. I'm a registered investment advisor, and the world has become more complicated in terms of compliance, technology needs, back office support, fee processing. So I reached out to a firm called Great Valley Advisor Group. And along the way, basically, they found out the type of work that I was doing in terms of asset allocation modeling and economic research. So in bringing my RIA into the Great Valley Advisor Group community, became their chief market strategist. So in my work at GVA, building investment models and serving our advisor clients all across the country.
Okay, so then you are the right person to ask about the outlook on the economy, business, markets. In general, what do you see happening? What's coming on? What's on board for the next year for us?
Well, it's really been an interesting time. You think about where we've been coming off of the financial crisis, and we had 13 years where we had interest rates pinned effectively at 0%. At a time when economic growth was positive, but it was chronically sluggish. So we had this constant back and forth of disinflation, if not outright deflation, slow economic growth, and always a concern that the Federal Reserve would need to step in and provide monetary policy support to protect us from the next crisis. But then we had COVID, and we had the extraordinary policy response to COVID, which in its aftermath, it was so extraordinary that it helped spark a pretty sizable inflation outbreak that we've had over the last couple of years. So we had, for the first time since the 1970s, culminating in 2022, an extremely difficult market environment, not only for equities, but also for bonds at the same time. Now, in 2023, we've seen a fairly strong recovery in the stock market, but it's been a middling performance for the bond market. And as you and Jeff were talking about earlier, it's tough the last few months, basically August, September, and October, a difficult time in terms of equity market returns, but also particularly in the fixed income market. But as we head into the end of the year, I'm no stranger to downside risk. I'm no stranger to being bearish and recognizing where risk exists in the marketplace. But I would say I'm probably about as constructive as I've been on both equities and bonds and capital markets in general as I've been in years. We have an economy that has proven resilient in 2023. All the expectations going into the 2023 calendar year was, recession by the second half of 2023. Well, that never really materialized. I mean, we have a labor market that's been fairly tight. We have a housing market that's held up well. And now we're in a phase where, although economic growth is slowing somewhat, we have improving corporate earnings, corporate profit margins are widening, and probably the most important element is inflationary pressures continue to subside, both on the headline and the core basis. So the setup is favorable not only for stocks but also for bonds as we go into 2024.
So likely above average type performance for stocks and bonds over the next 12 months?
Yeah, I think if I had to choose between stocks or bonds in terms of what I'm even more excited about, I'm even more constructive on the bond market than I am on the stock market. We had inflation peak in the summer of 2022 on a headline basis, and then peaked on the core in the fall of 2022. And inflationary pressures were increasingly coming down. And we saw a bond market rally that we would expect to see coming off the October lows into the spring of 2023. But then the bond market rolled over. And as Jeff talked about earlier in the show, it was a particularly tough stretch. Basically that period from July all the way through to the end of October, where we saw the 10-year Treasury yield push its way all the way up to 5%. But this was taking place in an environment where inflation was coming down. And given that inflation is a primary determinant of bond market returns, that suggested that a real opportunity was starting to come together. Now, we've seen a swift decline in Treasury yields. Bond yields come down, bond prices go up. So it's been a heck of a rally in Treasuries and the bond market in general through the month of November and into December. But there's still a fair amount of room in our view in terms of inflation continuing to come down, get into a glide path, but to be supportive of continued bond market upside as we go into the new year.
Eric, I got a question for you. It sounds like what you're saying, the backdrop for U.S. domestic equities and fixed income is favorable. Mm-hmm. What are your views on international emerging markets, equity stocks? How are you what's your view on international investing right now?
No, that's a great question because, one of the challenges associated with investing outside of the U.S., it's a theme we've heard for years, is, the great value that exists in developed international markets or emerging markets relative to the U.S. I mean, we can go all the way back to 2010 and 2011, and we had a divergence where the U.S. equity market continued to rise year after year outside of, short-term periods of correction. But developed international markets and emerging markets, they effectively languished. It's been over a decade of sideways performance and sideways returns. So an attractive relative value opportunity has really been presenting itself for years. But it's been an exercise in frustration for investors trying to capture that relative value opportunity because the U.S. bias continues to be rewarded. We've continued to see U.S. markets outperform developed international and emerging markets. So the question is, okay, that value is there. There's attractive opportunities in these markets. One, does it make sense to try to capture them now? I mean, when is this inflection point going to finally take place? And two, if we were to seek to capitalize on it now or seek to position for it now, what would be the reasons and the catalysts that would cause for this change to take place, potentially in the coming year or in the next few years? And I would say the biggest thing is the change in the policy environment. All the way up until the early 2022, we had a Fed funds rate that was effectively trapped at 0%. And we had chronic disinflation. But because of the inflation outbreak that we saw in 2022, and we're coming down from it in 2023, that finally broke the monetary policy fever. We have a Fed funds rate that's above 5% for the first time since before the financial crisis. It was a difficult stretch that we went through from 2021 to 2023 in terms of the outbreak of inflation. But the silver lining associated with that as we go towards the middle of the decade is it allowed for policy normalization. It allowed for monetary policy to get back on a normal course where we're talking about 2% to 3% inflation on a sustained basis going forward. And we're talking about monetary policy. We're not talking about negative interest rates in certain markets across the country or across the world anymore. We're talking about normal finance and the normal application of fundamental analysis in our investment decision-making process.
So Eric, how is that? Yeah, how is that favorable for the emerging markets more so than it is for the developed markets? And another question or comment, I guess, it seems like these emerging markets in my history seem like they're always emerging. When do they
Oh,
become developed?
no, a
And
lot of great questions there. So the first thing is, I would continue to overweight U.S. relative to developed international and emerging. I think the U.S. bias continues to get rewarded. And yes, the U.S. stock market has done really well in 2023, but a lot of those positive returns have been concentrated in 7 stocks. You take away the so-called Magnificent Seven that make up about 85% of the positive return in the S&P 500 this year, and the rest of the market has been largely left behind. And that not only includes mid-cap U.S. stocks and small cap U.S. stocks, but a good portion of the S&P 500 outside of those maybe 7 or 12 names at the top of the index. So I think there's a tremendous upside opportunity in the U.S., not only from a fundamental improvement in terms of corporate earnings and profit margins, but we're seeing value in certain areas of the U.S. equity market, mid caps and small caps, discounted values that we haven't seen in decades. So, we continue to favor the U.S. In terms of developed international and emerging markets in particular, one has to be selective. And you make a really good point about emerging markets, because one of what I would contend to be is the misperceptions about how to allocate to emerging markets. When we allocate the stocks in the U.S., we think of the S&P 500 index, and it provides a representation, a market cap weighted representation of the biggest stocks in the U.S. So the notion among many investors is that, well, if we want to invest in emerging markets, we should just be market cap weighted to emerging markets. But I don't necessarily subscribe that that's the best way to do that, because just because an economy and its market may be very big outside of the U.S. Doesn't mean that that's necessarily an attractive investment opportunity, because the regulatory environment, the rule of law, and how it's applied in that economy may not be a place where capital is going to be treated well and a place where we want to allocate capital. But most emerging market indices will place a heavy overweight to an economy like China, for example, which has seen really challenged performance and, a pretty challenging economic environment over the last few years. So one of the ways that we seek to allocate to markets outside of the U.S., particularly emerging markets, is to not be so benchmark dependent and instead focus on economies that we would refer to as being in transition. Economies that maybe are coming out of autocracy and are seeking to transition more to democracy and economic freedom and the adaptation of the rule of law. Because there's a fair amount of research that suggests that those economies and the markets in those economies have been able to deliver relative outperformance to the emerging market benchmark and to global ex-US benchmarks with meaningfully less risk performance over time.
Thanks, Eric. I got a question for you.
Absolutely.
Concerning the global economy, concerning the U.S. economy, let's make it very broad. What are the biggest downside risks that you're seeing? Risks out there that you're seeing. What's keeping you up at night? Can you expand upon that a little, please?
Absolutely. So the biggest downside risk, in my view, is the biggest downside risk going into the second half of the year, and it continues to be going into 2024, is the renewed outbreak of inflation. One of the biggest keys to the equity market rally and the bond market rally in the second half of 2023, and for the remainder of 2023, that is, and into 2024, is the fact that inflation continues to come down. If we enter into a market environment in 2024, an economic environment where inflationary pressures start to rise, a repeat of some of the things that we saw in the 1970s, where inflation would come down and then all of a sudden it would shoot back up again, that presents a real dilemma for equity markets and for the fixed income markets, because it means monetary policymakers will have to get back to aggressively raising interest rates. If we see a renewed rise in inflationary pressures, that would be arguably, in my view, the biggest downside risk. Another downside risk that gets talked about, but I think needs to be considered in context, is the threat of geopolitical events. They can be shocking to the equity market in the short term. The bond markets in general, and the treasury market in particular, tends to do well when you have geopolitical shock events like what we saw in the Middle East here back at the beginning of October. But they tend to be fleeting. You'll see a short-term correction, 5, 6, 7%, as much, maybe even more. But more often than not, 2 to 3 weeks after the outbreak of the event, unless it's really dramatic, we tend to see the equity market rebound. So when we hear about things like whether it's a geopolitical event or dysfunction in Washington from a political perspective, that can cause short-term market shocks. But I think investors would be well served to see those types of shocks as opportunities to basically buy in and add to positions when they take place.
So that that I guess your underlying thesis of it's going to be a powerful kind of environment, a positive environment, holds even through the shocks that you're seeing, because you see those as maybe being more transient. Let me know if I'm wrong on that. But then my one last question, we just have another minute here.
Sure.
How would investors invest in these international emerging markets versus U.S. markets? Do they buy a broad global index or that encompasses the entire globe, or do they have some individual countries that you think specifically they should focus on?
Yeah, I think in the in the U.S. Differentiating by size, I think being style neutral, growth versus value, is a good way to go in this market environment. I think the current market environment over the next 5 years favors value over growth, but that's probably marginal at best. In international markets, I think when it comes to developed international markets, a more passive approach, maybe with a little bit of alpha generation tied into it, a little bit of an active overlay, is a good way to do it. When it comes to emerging markets, you have to be a lot more selective in our view, that it's not necessarily just buying the market cap weight, because there is such a differentiation between the economies that exist in emerging markets. You want to identify a manager who can really pick and choose what they think the best markets are to be able to add value for your portfolios.
Okay, so something that's more of an active manager than a passive index. And we're seeing that in the U.S. as well, just over the last couple of years, these big divergences, as you're pointing out, between value and growth. Magnificent Seven dominating the market over everything else. So it's really gotten to be where if you're in a broad market index, you're going to capture some of that. If you're picking wrong, you could be flat instead of up 20% on the year.
Absolutely.
So, Eric, I really appreciate it and your insight and the vast amount of knowledge you bring and your background to this. Thank you very much for appearing on the show.
Thanks for having me today. I really appreciate it.
Very good. And our next guest on Money Matters TV is Adam Battersby, president of Pro Batter Sports. Thank you for watching Money Matters TV, and we look forward to having you back next time where your money matters.